So, good morning, all of you. Thank you so much for taking the time out to attend this session. I would like to first of all set the context for what we would like to and why we thought of doing this session. All of you are aware how volatile the markets is. There's a bout of correction or downside that we are witnessing for various reasons, which we will be speaking about in little more detail as we proceed through the presentation. There are opportunities we believe that one could again relook at topping up their investments as a lump sum investment. There are many people tend to have a confusion, especially newer investors who have joined the investment journey. Tend to have some kind of doubts on which one works better, SIP works better. Especially if you're a new investor, the kind of questions we also get to see is markets are already bad and you're telling us to top up the investments. Does it work? When does it work? Why would it work? So the objective of this session is also is to first of all clarify basic concepts on how SIP works, on how lump sum works, what works well under different scenarios, and also to give you the key recent developments in the market and what is our view and what should be an approach for anyone who wishes to do it in a very structured, organized way so that they are able to meet the financial goals. As a house, we very strongly propagate the concept of financial planning for all because that gives so much clarity to why you're doing whatever you're doing. So, so this will be a combination of a learning session as well as our house view on how we see things panning out. Okay. So, without ado, I'll start the session. So, all of you have seen how the markets have been over the last 6 months to 1 year. It's been a volatile journey. It was a beautiful one, probably a linear move between 2020 and 2024, September 27th. Everyone was happy, markets were doing very well, and then the correction or the fall started. Most of you know how, if you see the 1 year charts for the key indices, which is Nifty 50, mid cap, as well as small cap, it's been from September to March 2025, it's been a significant fall. Lot of reasons for this. Initially, we attributed to overheated markets, overvaluation, fraud, IPO fraud. Then around February, the tariff story came into the picture. And then the quarterly numbers also did not help. The corporate results were probably gradually picking up and nothing great to talk about. So a combination of factors aided the fall in the market, and it's been quite a volatile journey, especially for new investors who are not used to this. So, at different points in time, when we do a financial planning for a client, we know what their financial goals are. We understand the timelines that is available to them. When we tell clients, so you have investors of all types, right? So when we tell clients that look at topping up your investments, market may not give you, especially there was this time when markets had come down to maybe Sensex had come down to something like 74,000 or thing. I'm talking about the key indices. There was significant correction even in the mid cap and the small cap space. So when we used to tell our clients that look at topping up your investments, somebody who used to agree with us was typically a seasoned investor who has seen probably different falls in the market over the last 10 to 15 years. And people who agreed with the concept of a lump sum, most of them fell into this category. Either their past returns have been attractive. Why were the past returns have been attractive? This is a point that I may be reiterating again and again. They have spent that time in the market. They may have seen the 2008 fall. They may have seen the 2015 yuan devaluation, 2020 COVID crisis. So it was a lot of experience in the market, because of which they were happy with the returns, long-term returns, and were agreeing to what our recommendation or suggestion to top up their investments. This is also combined with the clarity on their financial goals. They know, for probably, I'm just giving it as an illustration, a retirement goal. They know that I'm doing my SIP, but I still need to do a little more if I need to achieve this goal by this timeline, right? So a clarity on the financial goal also was one of the reasons they agreed, plus a realignment of portfolio. Again, coming back to a basic concept of financial planning, the beauty of this exercise is that it gives you an overall perspective on how much you're earning on your overall returns, all your assets put together. It could be your shares, it could be your mutual funds, your property, your PPF, EPF, Sukanya Samriddhi, everything put together. So when you know your overall returns are low, you use such opportunities to increase your investments in a particular asset class, specifically equities, and try improving the rate of returns. So investors who typically agree with us, it could be driven by either market-based factors, their returns have been good, or goal-based factors. For this, one point I probably missed mentioning is when we talk about SIP and lump sum, we are veered a little more towards equity kind of investments, because when the market correction happens, it is mostly this is one segment that we look at topping up. Okay. Some of them have their fear, have queries, and this is especially with new investors. And these are the typical comments that we see when we recommend probably a one-time investment or a lump sum investment to investors. What are the typical fears? So many of them tell us, no, this time I think it is bad. I don't see it correcting, or I don't see it improving in the near future. So there's a general fear. I don't think the markets will recover fast. That's one. Second, markets are too volatile. I will wait for some stability. What people don't realize is markets do not wait for anyone. None of us can time the market. My 2 decade experience, if at all anything I can be, one of the things I can be sure of is this. Markets don't wait for anybody. So that's another general concern that people voice. There's nothing right or wrong, but these are all typical fears. Our observation is these are all the typical fears. One, market is bad. Second, markets are too volatile. Third, because especially for somebody who's entered the market recently, they may feel, I'm not earning any returns on the equity front. I might rather put it into an FD and protect my money. I'll at least get 7% pre-tax kind of returns. Many of them with a bigger surplus explore looking into other so-called safer assets like a real estate. The perception is that real estate will anyway do well, will anyway give them a return over a period of time. There have been in many instances when it probably may not have moved, or the returns may have been lower than an equity asset class. But still, people tend to prefer real estate during volatile market times. And as I mentioned, beginners, people who entered, just in, if I give the last few years as a context, people who entered in 2024-25 may have been really disappointed. Their thinking is, I put my money, markets were doing so well, now my returns are so bad, and on top of it, you're telling me to top it up. Will I really make money? What is the use? So these are the fears that people have when there is some kind of a volatility or market correction, and they hesitate to put in more money. So it could basically arise because of the three reasons that I have mentioned below. A lack of clarity on your financial goals. Normally, somebody seasoned investor or someone who knows about their financial plan, financial goals, the timeline, what is required, have a sense on how much more needs to be done. So such fears tend to reduce when you have clarity on your financial goals. Second, lack of clarity on your asset allocation, and most important thing, lack of understanding on how market works. So the third point is something that we will dwell on in the coming slides. The purpose of this also is to, one, as I mentioned earlier, to remove the confusion, which works better, lump sum or SIP. Does it really make a difference? What is the kind of return? So let us take actual scenarios that have happened in the past. While we do know that past returns is not a guarantee for future one, but they give you a sense of understanding on how things could probably pan out also. So If you see the last from 2000, the last 25 years, which is a reasonably good time span to take into consideration, and that's when our Indian markets also grew and grew both in terms of quantitative numbers and in terms of the kind of products, ease of doing every manner. So the people who have been in the markets know the 2000 dot-com bubble. There were earlier crashes also, maybe in 93 and one in 96, if I'm not wrong. 2000 dot-com bubble was something that really impacted investors. As you can see, the decline in the indices was almost 50%. Then there have been many other falls. So these the seven ones listed below. 2004 there was an election. 2006 there was a global rate sell-off. Lehman Brothers is another very famous crash. Then 2015 there was a yuan devaluation. 2020 COVID, very recent. Most of us cannot forget. So all these times, look at the kind of fall that the market has seen. 50% in 2008, it's minus 60%. In COVID, it was almost minus 40%. So it's not that we have not seen such kind of correction. The point that we are trying to drive is what has happened after that. Do such crashes or falls give an opportunity for somebody with a long-term perspective? So after this crash, has the market remained the same? No. As you can see from this particular chart, 1980 to 2025 data we have put. After every fall, there has been a rise. Okay, there will be. Markets do not remain always in negative territory. Markets do not always remain in positive territory. It is, as an asset class, it is going to be volatile. It will give you opportunities to exit as well as to be cautious as well as to enter. Okay, so it's not that what remains negative is going to continue for a thing. Again, coming back to the core point, if you know your goal, you would not be perturbed by such market falls. But the key point that we are trying to drive here is there has always been a recovery after every market fall. So just as an example to tell you whether a lump sum investment would work, and because our topic also is lump sum or SIP, what works better? Ideally, as somebody who's been doing financial plan for clients, I would say a combination of both. There are a lot of factors. It depends how whether you get a scope. There is a scope for a lump sum inflow in your earning years, which works better for you, which is easier for you is what thing. I would any day prefer SIP as a route for reasons that we will speak about later. So we will take these five incidents. Y2K bubble, which is in 2000. It lasted from 2000, Jan 2000 to September 2001. If you see, the markets fell by almost 46%. Lehman Brothers, Jan 2008 to March 2009, fell by 41%. European crisis between 2010 and 11, when it fell by 26%. Yuan devaluation in 2015, when it fell by 21%. And COVID, 37%. So we are just for illustration purpose to see if I had entered the market both as a lump sum investment and as an SIP, what is the returns that I have earned? Have I really made money is what we will see. So let's take each instance. Okay. So we'll first start with the Y2K bubble one. So as we mentioned, it was there for almost 20 months. Okay. For an illustration purpose, I've taken a very popular flexi cap. This is again not a caveat. It is not a product recommendation. Just for illustration example, we have taken HDFC flexi cap and seen how a lump sum investment has worked and an SIP investment has worked. So if I had invested, the bottom was something in September 2001. Okay, in Jan 2000 when it started falling. The bottom Nifty was at 1638.7, and in September 2001 we came down to 872. Assuming I had put lump sum investment into HDFC Flexi Cap, the NAV on that date was 15.95, 24 years back. Okay. And I was holding it on till August 1st of 2025. My annualized returns for that lump sum investment would have been 22.23%. SIP returns is also not trailing much. It would have been 19.3%. Okay. Let's take the next market fall. Lehman Brothers financial crisis in 2008. If you see Nifty, from Jan 2008, when the Nifty was at about 6287.8, it fell all the way down to 2576 in March 2009, a 41% fall. This downside period lasted for almost 14 months. So this is, see, if you see, even in September 2000, Nifty was at 872. In Jan 2008, we were almost at 6287. So in between also, there's been a good recovery, right? So assuming I had put my money in March 2nd, 2009 in HDFC FlexiCap, again, I saw, oh, markets have corrected. Now this is a good time to enter. And if I had put a lump sum, NAV was at 96.22. And if I had held on again till August 1st, I would have earned lump sum return of 20 and in SIP returns of 16.4%, both good, right? So in every market downfall, we are seeing the kind of very good returns. In 2011, again, if assuming December 1st, 2011, I had put in money after the closer to the fall of that particular fall. The European debt crisis lasted from November 2010 to December 2011. I would have won 16.72% and 17.27%. So similarly in yuan devaluation, and last is COVID. COVID is something most of us would remember because it's pretty recent, we would say. The market actually started falling sometime in January itself. It's not even March 2nd when this date is actually January 12,362. It fell all the way to 7,800, a 37% fall. And this fall was the steepest, not even less than 3 months kind of a time period. If I had again pumped in money, in fact, we recommended to a lot of clients to look at index options for long-term investing. If I put my money into HDFC Flexi Cap, I would have earned 32% return and SIP returns of 24.03%, right? So in every market downfall, I gives an opportunity for somebody who's investing for the long term to make superior returns, right? We normally say it is good if you can expect a 12 to 15% kind of returns on your equity investments. Such market corrections, if you understand, if you trust how the markets would pan out over a longer time frame, don't see short term, longer time frame, these corrections give you a very good opportunity to earn superior returns, as we can see, right? Now, same thing, if I had, instead of putting it in the market fall, if I had even put it in January 1st, 2020, when the markets actually started correcting, right? I would have still earned 20% and 23% on lump sum and SIP returns. So there are many points that we are thinking. One, there is such corrections give you an opportunity for a long-term investor, not a short-term. For a long-term investor, somebody who's ready to take more than a 3+ year time time horizon while investing, and it helps you to bridge the gap between your goal achievement and where you are currently. Now, many of them also say, that's a point also I mentioned. Many come to us in such volatile markets when there is general fear on whether am I doing the right thing by pumping more money into equity markets through SIP or through lump sum. People do come and tell us that I'd rather put my money into an FD or gold or some other asset class. I probably may earn higher returns. Definitely, in the short term, we don't dispute that. Maybe if you take a shorter term time horizon, 6 months to 8 months, your answer is right. You would be right in the sense you may earn higher returns. But there is always a part of your investment that should be to build the corpus, and that only equities as an asset class can give you. And that is why there should be some allocation towards this. We are very strong proponents of asset allocation. If there are any two factors that help you create that corpus in your wealth investment journey, one is discipline, second is right asset allocation, because it helps you protect the downside and to earn good risk adjusted returns. So assuming This particular table just shows that instead of HDFC Flexi Cap, I had put my money into an FD, gold, or PPF. I've taken two scenarios. The first is I've taken it in March 2nd, 2009, just before after the Lehman Brothers financial crisis, when again the markets were about to go up. This is a theoretical assumption that I've been able to time the market well. Please keep this particular point in mind. Okay. As you can see, an investment in equity class, HDFC Flexi Cap has given me 20.7%. The same thing if I had continued in an FD or gold or PPF, these would have been the annualized kind of returns. If you see the second table, April 1st, 2020, when again I'm theoretically assuming I've been able to catch the bottom and stay invested, HDFC Flexi Cap would have given me 32%. Gold has done better. If you see, it's given almost 17%. FD and PPF have FD PPF is about 7.5% and FD has given lower rates of return. So while asset allocation is important, you need to comprehend and understand why such opportunities are given, and if you're fortunate to have that availability of those funds, use it as an opportunity to top it up for long-term investment purpose. But you can look at overall asset allocation as part of your investment journey, but such market corrections provide you such beautiful opportunities to earn that superior kind of returns vis-a-vis other asset classes also. So if you can, as you can see in the table, there's not been significant difference between a lump sum and SIP kind of investing. But so when does both work? SIP is as a house, and you ask any financial planner, nothing works better than an SIP. One, because it brings in that discipline. Most of us will have opportunities when we get some kind of a lump sum kind of inflow, but not all of us have that lucky are that lucky to have a regular source of inflow, right? So SIP creates one structure, one habit, one discipline. Wealth is also like any other part of life. It's a habit. 80% is habit, 20% is where you put your money. Okay. So it brings in a structure to your investment journey. Second, automatically ensures rupee cost averaging. You don't need to time the market like how you may have to do in a lump sum investment. All the above examples that I showed is a very big assumption that I've been able to time the market perfectly. The point that we are really trying to drive is utilize these opportunities. Not all of us will get it right always, but if you think, as you've given your understanding, if you think markets have corrected, there's been a reasonable downfall, and from a long-term point of view, I will still be safe, look at it as an opportunity. Okay. So SIP for a regular investor, typical retail investor, any day works better. But lump sum also, time in if you give it the time, it has yielded returns as good as an SIP. So what we would say in conclusion for these two is there is no one size fits all. A combination approach would always help you earn good returns, right? So what are the multiple factors? See, when you are doing a lump sum investment, there are multiple factors that come into the picture that you need to have a broader sense when you're making a lump sum investment. If you're doing it yourself, you need to understand what reforms are happening, how are the corporate results, what's the bank rate, inflation rate, is inflation increasing or reducing, how is it going to impact the economy, what are the geopolitical factors. We have seen it's the last 5 6 years, while given how even though markets have been reasonably volatile, it's given us the best experience and exposure to how geopolitical concerns could impact our markets. Our own monetary policies, what is RBI stand, what is RBI's view on GDP rates, what is their view on interest rates, liquidity, global interest rates, and FIF flows, and finally valuations. Nothing speaks more about why the market is going up and down is valuations. Very strongly, a war may happen, short-term events like tariffs may happen. So there may be such small developments on the macro front. But the net bottom line result is if your corporate earnings are good, markets will reward you, definitely reward you. So there are many examples that we can take in terms of specific stocks where if you see their valuations, if you see what PE, what price by book they are trading, it's always high. You will never get such stocks. So market always rewards earnings and that is reflected in the valuation. So when you're doing your lump sum investment, if you think you can time the market, have a broad sense on all these factors because you need to get a grip of all this before you take a decision. Now, so there are some core principles that we'll just touch upon. Again, reiterating the fact that whether you do SIP, well, we would always recommend a combination approach, SIP or a lump sum. There are a few basic principles that one needs to keep in mind when in their investment journey in order to earn superior returns. One, time versus timing the market. There are plenty of experts. If you watch the TV channels, business channels, you would hear them saying, nobody gets it right while trying to time the market. It is only time in the market that has helped, be it Mr. Radhakrishnan Damani or Rakesh Jhunjhunwala, whoever it may be, you take any investor, the time in the market. There are one or two who get calls perfectly, but by and large, for most of them, it is how much time they've spent in the market. We have seen it in our own example. There'll be investors who would have gotten into some funds in maybe 2007, 8, did not do well between 2010 and 15, and again probably picked up. Just by sheer staying in the market, if you see their annualized returns today in 2025, it will easily be between 13 to 16% annualized return. So sometimes just being there helps. This is just a data on how if you had booked profits at 20%, 30%, 50%, what is the kind of return vis-a-vis if you had held on to the investment. So something like 2015 to 2024, right? If you had booked your profits at 20% gain itself, you would have earned net only 2 point, the kind of annualized result performance is only 2.1%, whereas if you had held it on till 2025, 2024, it would be 12.4%. So there are many data points like this, again driving the same point. So buy and hold in a good investment will always pay you, right? Again, there are many people who, while profit booking is good, profit booking is necessary. Sometimes in some investments, you should stay put to till the time you achieve the goal. Many of them are tempted to realign, keep taking out the profit and then look for another opportunity to invest. Nothing right or wrong about it, but it does have an impact on your overall returns. This table again just gives you an overview on that. If you miss the best days, so if growth of 1 lakh in Nifty over 2025, over the last 25 years, if you had stayed fully invested, irrespective of how the days were, your returns, annualized returns will be 13.26%. Vis-a-vis if somebody who missed the best 10 days, it will be 9.5%. If they had missed the best 40 days, it's going to be only 2.93%. So the market gives you opportunities for spikes and it truly rewards people who have been there. This is again just a data. This is not a recommendation for any of the funds or any of the products mentioned here. It is just to tell you that people who have stayed invested, the kind of compounded annualized returns they have gotten in certain large cap and mid cap categories, right? And flexi cap categories, just by being there in the market, 15%, 16% kind of returns. These are really extremely good returns. Why they are very important? They help you build that corpus for a comfortable life. Now, when we do retirement planning, typically now we as the recent trend is it's good to have a 10 crore corpus because not only for retirement, it helps you meet a lot of other financial goals. If you have that kind of an aspiration to touch the 10 crores, which is not impossible actually, which is highly possible because we have worked it out with numbers and seen it with our own clients. If you have that kind of aspiration, you need to stay put for that particular time period in the market. So this is again just a data point on how somebody who has been invested will earn this kind of returns. So when you're doing a systematic lump sum investment, one way of doing it smartly is to do it in an STP mode or systematic transfer mode. Okay, so how it works? You first put your money only into a debt fund, and then over X number of weeks, you move it to the equity fund. That's your perception on the market. You think markets will again pick up in 12 weeks or 15 weeks or 20 weeks or 25 weeks, whatever it may be. Do it in an STP mode. Even when you're doing as a lump sum purchase, it is advisable not to put it all at one shot. Park it in a debt fund and gradually move it to an equity fund. This is in the case of a mutual fund we are suggesting. So it works like a reverse SIP. There's an automatic rupee cost averaging, and it's a smart way to handle the volatility also. So even when you're doing as a lump sum investment, one time purchase, try doing it in a STP mode. Again, for that was with lump sum. Second, when you're doing an SIP, try increasing, stepping up your SIP. This is really a miracle that if you can work it out with Excel at your own end, you will see. Try increasing your SIP, step up your SIP by 5 to 10% every year. The time period in which you are able to achieve your corpus significantly reduces. So if you see the zone table, if somebody who started with 10,000 rupees SIP and assuming there's a 10% annual increase, like what it is mentioned here, they will achieve the 1 crore corpus in 15 years and 10 months. But someone who does with 20,000 and increases will be able to achieve it in 12 years, right? So the time period for you to achieve your goal significantly reduces if you have the discipline to step up your SIP every year. As your income increases, the first thing you should be doing is try increasing your SIP in order to achieve your goals faster. So as a conclusion, we'll say there is no one right way to invest. More important is you have the discipline of regular investing, regularly working towards your goal. Use SIP for sustained investment process, and use lump sum investments to top it up and to reduce the time required to achieve a goal. Right? So both have yielded returns as we have seen in the different market fall scenarios. So it's up to you how you utilize these opportunities and how much time you give for your investments to work. Now we'll move to key market updates. We'll try telling you what is our house view and why, how you could probably view the markets. Yesterday we saw the news that our Q1 GDP numbers have come in at 7.8%. This is much higher than what even RBI had predicted for the first quarter. RBI had budgeted 6.5%. This has been driven by a few core sectors like cement and steel, extremely good numbers. Second, we'll just touch upon the tariff part. This is again, in this morning, there has been a development to this news. A federal court in US has dismissed Trump's claims that he has no authority to rule over the tariffs the way he has worked it out. But it's still not a conclusion. The story is still panning out. So there is still uncertainty. Our our understanding is that the impact of this 50% tariff will be on a few sectors, and the impact on GDP will be to the extent of 0.6 to 0.8%. Please note that some key sectors like pharmaceuticals, electronics, IT is still out of the purview of the 50% tariffs. We will be badly hit if these sectors also come in. Right now, there are two assumptions that one, some negotiations will offset this 50% tariffs, and second, these pharmaceuticals and electronics, IT, and few other important export-driven sectors for us, for Indian economy, will not be affected. So overall impact on GDP is not expected to be more than 0.6 to 0.8% because of this 50% additional tariffs. It is an impact, but not so significant. So these are some of the industries where it's going to be impacted: gems and jewelry, some of the automobile components, textiles in a very big way. While reading about a lot of economists' views, while the impact on GDP is 0.6 to 0.8%, uh, the real the real impact we are probably going to see is in employment numbers. because these are all industries where it employs a huge number of people. So, if at all some a part of our thing is going, which may affect consumption later, is the actual employment numbers. We think the markets have already factored a lot of this tariff impact. It's down almost 4 to 6% from its highs. Probably you will see some volatility, but most of the tariff impact we think is in place. Okay. We also There's a general assumption that a trade deal will eventually come into picture, and negotiation posturing and all that will offset this thing, and there could be some reversal. Okay. Yeah. So what has the government immediately taken? Our Indian government has been very proactive in taking a lot of initiatives to offset the impact of these tariffs. New PLI schemes, export credit guarantee schemes for our manufacturing units, removal of cotton import duty to help the textile industry. Import duty of almost 11% was there. And most important thing is the GST rationalization. So what they have proposed is, and this is significantly expected to bring down, lower the cost of the goods and promote consumption indirectly. So there were four slabs, 5, 12, 18 and 28%. The government now intends to have only two slabs, 5% and 18%. So most of the 12% slabs will move to 5% and 28 will move to 18%. So there will be only two slabs, significant reduction in our cost of purchase and more resources available for consumption. So this may propel higher household savings, stronger consumption demand with the lag effect. Why we are saying this? So you may not see the results immediately. There could be opportunity. This will all translate after a period of time. One more thing which is not mentioned here is, if you are aware that RBI had reduced the bank rate by almost 1.5%, right? So that lag effect will also start coming from December or so. So there are a lot of positives in place for the Indian economy as we go ahead. S&P upgrade also has happened from triple B negative to BBB positive. First time after many years. So this will also lower the cost of funds for our corporates, reduce their borrowing costs, and generally boost investor confidence. Domestic macros. The expectation is that as an economy, we are currently at about 3.94 trillion. We should be touching 10 trillion by 2035. This is the general expectation. Okay, even if we do the current rate of growth of about 6 to 6.5%. So if the economy is going to be, if somebody is positive and believes this story, markets have to follow the trend, and markets will follow this growth, right? Why One of the data that is backing this is, if you see two countries, China and Indonesia, there was a big jump in their GDP once they hit the 2000 per capita income measure. India is just getting there, so probably we are at an inflection point. Okay, we even in terms of inflows from a market perspective, our weight is only 1.6 was only 1.6% 2 years back in 2023. As our economy grows, as we become one of the top three economies, our weightage in the overall indices of the global players will also increase, and this will also drive in a lot of FIIs. We are already seeing how SIPs and domestic investors are contributing to the market remaining stable in spite of huge FII outflows. So that will also continue over the next decade or so. Index valuations, we are not very cheap, but we are significantly, there has been a correction when compared to what it was. This is a little dated data, but I have not changed this because markets are more or less at the same level as of August 8th, right? So Nifty current PE valuations is 21.7 as against last 5-year average of 22.7. If you see even the mid cap index, it's still high current PE average. So there is a scope for correction. So even if you're get into either as an SIP mode or as a lump sum mode, right? Broadly, this is the few takeaways. Trump tariffs have grabbed, but with headlines, but we think more or less it's in the market. the impact is going to be 0.6 to 0.8% of our GDP. Macro parameters continue to be strong for us, and domestic inflows and domestic institutional investor participation is also helping us to hold the market. So do follow a structured process to your investments. Take a understand your financial goals and do it. That always helps. So as a house, we strongly recommend financial planning, because that should be the basis for any of your investment. It should be your goals plus your time horizon plus your risk that should decide where your investment is going, and not the product and the returns, right? So have an asset allocation, have a goal-based approach that will always help you earn a good risk-adjusted returns in the long run. So we come to the end of the session. Very quickly about Right Horizons. We are a 23-year-old financial planning and investment advisory firm. We also have our own in-house PMS. It's close to a 75 member strong team, 7 branches across the country, and our core forte is in financial planning and understanding the investment and cash flow objectives of our investor, and accordingly recommend. We are not product driven, but more goal based driven investment advisory firm. These are our credentials. You could reach my colleague Tara, who's also there with me today, in case you wish to reach out to any of us. She has shared a link for a financial health checkup. It's request all of you to take it. It gives you a very good quick overview on where probably you're not doing, or some area that you need to address, or even if you have done enough. So it's a quick, it just takes 2 minutes. Request you to take the survey. This brings me to the end of the session.